Marquee event, so we're thrilled that you're here. For those that were here last year, we had Bert White, Chief Investment Officer of LPL, and again, for those of us who were here, that was an entertaining night and lots of fun. And so this year we had to top Bert, and I'm thrilled that we have somebody here who is equally impressive. Jeff Ptak, who is President and Chief Investment Officer of Morningstar. And most of you should be familiar with Morningstar, particularly the old-timers. I remember when I was young and I was working in my mother's accounting office, Morningstar had those big binders, remember those? And was it like every month the little the inserts would come, and every month I'd have to put the inserts in, and then sometimes I'd be lazy and I wouldn't put them in, and then we had older versions of the Morningstar reports, and I don't know if any of you remember seeing those, but we had big, thick binders, and of course today we've evolved, and we went to CDs, which would come once a month, and now just everything magically appears on your desktop, which is a lot easier than when I was a child. So Morningstar is a fabulous organization, and they're located in Chicago. They stand for a lot of things that really resonate with us and should resonate with you, but the main things that I believe they stand for are independence and objectivity and a real focus on shareholders and shareholder value, which is really, really important to us. So we are so proud that Jeff is here. He is like a movie star in his business, so it's the equivalent of me introducing Bruce Springsteen. So I am thrilled to have my version of Bruce Springsteen here.
Okay, good evening. That certainly is the most rousing introduction. I have to tell my wife about this one. So impressed.
Rousing introduction.
So I wanted to start off first, of course, by thanking Debbie and the team at LPL Financial for putting on this lovely evening. I know you all join me in applauding for this wonderful dinner they set up for us. So we'll get started in a second here. Maybe a quick word of introduction. I think Debbie did a great job of giving you some context on the firm that I represent, name of which is Morningstar, and then also a little bit of background on me. So I'm what you might call an unreformed former analyst. I came up through the ranks at Morningstar as a fund analyst, and I did a little bit of stock analysis, helped out with ETF research, and then I jumped over to the investment management side, which is where you can find me today. So really what we're going to try to do tonight is give you a little bit of context on the market and maybe some, we hope, actionable ideas on maybe how it is you position or tweak a portfolio given what's going on around us, right? And I'm going to offer that to you through the lens of an analyst, which is what I consider myself to be, certainly what I aspire to be in my darker moments. So why don't we go ahead and we'll get started. A few ground rules. Right? One is we have wonderful food and drink here, right? So I don't want to deprive anybody from that. You get hungry, you want something to drink, by all means, go ahead. You're not going to disturb me at all. This is wonderful here, so let's take advantage of it. The other thing is, I'm more than happy to entertain any questions that you have as we're giving the talk here. I've got probably about, let's call it 25, 30 minutes of prepared remarks, and then I know that we've left some time at the end for Q&A. So we'll leave ample time for Q&A. But should you want me to elaborate on something, or if you've got a question that's burning, holler at me, and we'll talk about it right there and then, okay? So let's go ahead. I'll set this glass of water down, and we'll put this clicker to the test and get started with the presentation. So let's go ahead and we'll set the agenda. I wanted to keep this loose, but at the same time I wanted it to be organized. And so we set an agenda here. And so we'll spend a few minutes sort of giving you a look back, right? You summarize the quarter that was in the capital markets, and then we're going to spend some time trying to put the market's recent returns into context, right? Where are we? Well, I think that probably you're all familiar. Maybe you look at your 401k or your investment statement, right? You've seen in recent years your investments, or at least we hope, have appreciated in value, right? So the question is, well, when's the jig up? Is this rally long in the tooth? We'll spend some time talking about that. I'll try and give you a little bit of context for where it is we think we are. And then we'll shift our gaze forward, and we'll try and posit an outlook of sorts. We'll give you some ideas for where we think the economy is and where we think it's headed, right? Expansion against recession. So we're going to get a recession in 2013. Or do we think that can be avoided? Where are the pitfalls in the market, and where, conversely, are those opportunities that we can try and take advantage of? That's what we're offering our outlook. That's the agenda right there. Again, I'll spend, call it 20. I'll try, and brevity's never been the soul of my wit, but I'll try and get through this quickly and leave ample time for you to ask questions at the end. So let's go ahead and we'll get started and summarize the markets. So the quickest way I can distill the first quarter was, if you like taking risk, you did pretty well in the first quarter. The first quarter was very kind indeed to risk takers, and we'll show this to you in pictorial form in a minute here. But whether we're talking about stocks versus bonds, or riskier bonds like high yield bonds versus safer so-called investment grade bonds, small caps versus large caps, right? Generally speaking, the further you inched out on that risk spectrum, the better you did. And that's, I would say, emblematic of the experience that we've had for over 4 years now in the capital markets since this rally commenced back in March of 2009. That's the first quarter in a nutshell. Here it is in pictorial form. And you can see Morningstar's flair for design does not extend to my slides in certain cases here, but it does the job. So just focus on the differences between these bars. This shows returns in the market in the first quarter. The leftmost column is the S&P 500 of large cap U.S. stocks. The Russell 2000 index of small cap stocks is to its right. You can see it was a good quarter for small cap stock investors, consistent with that trend, that theme of extending into risk and being rewarded for it. MSCI EFA, it's an index of foreign developed stocks. It was a profitable quarter for foreign stock investors, but not quite as profitable as it was for us U.S. stock investors. And then the big contrast here is when we look at the difference between stock returns and fixed income returns. I think that you're familiar with the fact that fixed income, by and large, at least in absolute terms, not quite as risky, right, as equities. And so that expressed itself during the quarter. Bonds lag stocks, though high yield bonds, which are shown in this rightmost column, which tend to be a little bit riskier in various ways, they did a bit better in the quarter. Okay, so we did our quick look back. And one of the questions that we routinely get as investment managers from advisors that we work with, like Debbie and their clients, is, where are we? This rally has seemingly come a long way, and should I be hunkering down? Is it time to get greedy, or ought I be fearful? And so I thought that, given that we've, just commemorated the 4-year anniversary of this rally, it might make some sense for us to spend some time placing this rally into context and trying to answer some basic questions. So let's get started with that right now. I've listed off 4 questions, some of them wonkier than others, I would admit. So when we talk about a correction, for those of you who aren't investment nerds like yours truly, right, we're really talking about the prospect of the market, or any asset for that matter, correcting in value, coming down in value, call it 10%, 20%, right? So are we due for a correction? The good times, we've been enjoying them for 4+ years. Are we due for a correction? Are stocks overvalued? Here's another one that I'll briefly explain, right? So, we go to the store, right? And we want to get good value. If we're, looking to buy, a gallon of milk, we want to look at the unit price, right? How much is it we're paying for that gallon, or any other fluid ounce for that matter, right? The same basic principle applies to any asset that any investment that you make. You want to get a good bang for your buck. The less you pay for that asset, generally speaking, one would hope the better the bang for your buck. And so in our parlance, that's valuation, right? So when we talk about undervaluations, things being undervalued, that means that we think you're getting a good bang for your buck. Overvaluation, conversely, that's when we think your dollar is going too far, right? That asset is overvalued and you don't stand to make good returns. So a key question for us to ask in the wake of the rally is, are stocks in particular, and we could extend this to other assets, but stocks in particular, do they look overvalued to us? Are bonds still a refuge, right? So bonds are typically the place that we go to hunker down. I used that term before, but we know that rates are plumbing the depths, right? And so we have to be cognizant of the fact that as rates rise, we can lose at least some real value in our bonds if we don't hold them to maturity. And so are they still that refuge that they've served as in the past? Another question that we would ask ourselves. And then finally, is this economic recovery made to last? 4 questions that I'll try to answer for you in the course of giving you some context on the market rally and the economic recovery. So let's jump right in. And so this is a slide that bears a little bit of explanation. It's pretty darn busy. And for those of you in the back, my apologies, you probably aren't going to be able to read the fine-grained detail here. But basically what someone did is they looked at this recovery, both in terms of duration and magnitude, and they compared it to other bull markets, I think in the post-World War II period. And so what can we observe? We can observe that through the end of March, this rally was 49 months old, and we had enjoyed a cumulative return of almost 105%, which sounds like a lot, right? But then we compare that to some basic statistical measures, averages and medians, and we see that actually the rally isn't particularly long in the tooth, at least by historical standards. The average rally has lasted, you can see it here, 67 months. And furthermore, in terms of magnitude, this one, believe it or not, has been a bit shallow, at least in terms of historical average. The average rally in the post-World War II period, 178%. So we still have not touched that high, at least as it's defined by historical average standards. That's one way we can set some context. What are some other ways? And actually, I should acknowledge for the JP Morgan representative that's here, you're going to see a number of JP Morgan slides. They put out a great slide deck every quarter, and so I've made liberal use of it, this being one such example. What is another thing that we might look at? Well, we would consider that the market has made new highs, and we might want to know, is the market looking frothy, right? Does it look like it's priced for perfection? And so something that I've encircled here, it's a couple things. It's the PE ratio of the market. This is how much in earnings our dollar is buying when we're making an investment. The lower it is, the more reasonably priced we would say stocks are. And we can observe something here. We can see that the PE multiple in the March 2000 peak was 25.6. We can see at the October 2007 peak, it was lower, 15.2 times earnings. And then we can see that last month, it was lower still, 13.8 times. So we've seen these peaks, you see them pictured here, but each time this earnings multiple, that bang for our buck that we're getting, has improved. It's not necessarily the sign of a frothy, dramatically overextended market. Here's another slide where we try to illustrate the same thing, and focus your attention on the top left. This is another earnings multiple. It's a forward earnings multiple. It's another measure of how over or undervalued the market is. The lower it is, the more undervalued we would tend to say an asset, or in this case, a market is. And so what can we observe? We can actually observe that right now, or I should say at the end of March, this S&P 500 was trading at barely 14 times forward earnings versus a historical average of around 16 times. So we wouldn't look at this and necessarily conclude that the market, again, frothy, or that this rally has outlived its useful life. The other things that we can observe in the bond market, right? I mentioned earlier that yields are plumbing the depths. I think it's self-evident to many of us in this room. I think what many investors, especially avid fixed income investors, don't realize is that yield is what you're probably going to have to live off of, right? Price appreciation is nice to get, but generally speaking, when we go and we look at the future, or I should say the subsequent returns of a bond, it's that yield to maturity. That's what your future return is going to be. And that's borne out by this slide here. We basically just we plotted out yields versus subsequent, I think it was 10-year returns. And what you find is that in most of these instances, the yield that you're earning on your bonds is what you're going to get over that subsequent 10-year period in nominal, not inflation-adjusted terms. And so you can see what the implication is here. At a 1.77% U.S. Treasury yield as of the end of March, we're looking at a pretty grim 10 years as fixed income investors. Remember, one of my questions is fixed income still a refuge? At least in these terms, we could say it necessarily is. Again, all in the spirit of context. Another thing that we can observe, and this chart will require a little bit of elaboration. So the S&P 500 index of stocks, as the name suggests, it consists of 500 different stocks, most of them large caps. And many of them pay dividend yields, right? So they don't just give you the hopes of earning capital appreciation. You also get paid, maybe in a quarterly or semi-annually or even an annual basis, some dividend yield, cash money, right? And normally, bonds yield more than stocks, right? It's somewhat axiomatic. We don't see that necessarily today. In fact, what we find is that almost 56% of S&P 500 stocks yield more than the 10-year Treasury. And nearly a quarter, actually more than a quarter, yield more than the 30-year Treasury. So this is a relationship that's been inverted. Again, these aren't necessarily the things that you would associate with a frothy stock market following a 4-year rally. Another thing that you wouldn't necessarily assume is that after a 4-year rally of the sort that we've had, that stock returns are going to be basically at parity with bond returns over the past decade. And yet that's what we see here, right? Stock returns, in fact, if you look back over 10 years, you find that stock returns are barely ahead of bond returns. This isn't the relationship that we would have observed back in certainly 2000, even 2007. So these aren't necessarily signs taken together that suggest that the equity market is badly overextended, right? Or that we all need to hunker down as equity investors. As I'm going to talk about here in a minute, that doesn't mean that we should be complacent or let our guard down or not be discerning. But it doesn't mean that, the equity market, is about to go to hell in a handbasket, right? These are all signs of that. So let's remember, I'm going to skip this in the interest of time, but actually let's talk about it really quickly. This is the economic recovery, okay? Sorry. I said brevity wasn't the soul of my wit, but let's cover it really quickly. We haven't talked about the economic recovery in terms of duration or magnitude, right? And so let's just focus on duration. What we observe about the duration of this particular economic recovery, it might seem like it's been going on for some time. But actually, when you look at the post-World War II recoveries, this recovery is about as long as the typical recovery. It's right on the button, the median, and it's actually a bit shorter than average. So even here, we wouldn't necessarily conclude that the economic recovery is long in the tooth. Actually, we would probably conclude otherwise. So let's return to those questions that I asked before. You remember that there were 4 of them, and I'll try to give you some uncharacteristically succinct answers to these questions. Let's take them one by one. Are we due for a correction in the equity market? Not necessarily, and I gave you those various reasons, looking at market multiples, looking at the relationship between stocks and bonds. There are various reasons that would lead us to believe that we're not necessarily due for a correction. Are stocks overvalued? When we look at those multiples, the market doesn't look grievously overvalued, and I gave you those various examples. Again, this is all in the spirit of setting some context. Are bonds still a refuge? I don't know that we can necessarily say that. From volatility, yes, but not in absolute terms. We saw what that projected 10-year return is on a 10-year bond. It's basically the yield, and the yield is very low indeed, and that's nominal. That's not inflation adjusted. So yes, ballast in a portfolio, but not necessarily a refuge, certainly in absolute terms. And is the recovery living on borrowed time? In terms of duration, I didn't show you magnitude. This has been a very tepid recovery indeed, well below average for post-World War II recoveries. We wouldn't look at this recovery and say, it's about to roll over. It's outlived its usefulness, right? It's a recovery, at least in statistical terms, that ought to continue rumbling on. So why don't I pause there and see if there's any questions before I jump in and talk about our market outlook. So we've done a little bit of look back, we've done a little bit of context setting, and now we're going to shift our gaze forward and try and give you some ideas about what it is we see happening out there and how that might inform portfolio positioning. Yes, sir.
Jeffrey, what about Europe? What about the EU? Where are they going these days? I have family in Ireland. They're in miserable shape. The EU as a currency certainly was a lot stronger than it is now. There are continuing problems throughout the Mediterranean and other countries in the EU. And doesn't that affect our market in the overall?
It certainly does, and I think everybody heard that question, so I won't repeat it. So Europe, right, a bit of a basket case. How might that radiate outward? Could it affect our markets? And the short answer is yes. I mean, one area where we clearly have seen the impact is in trade. So you'll recall that the manufacturing sector, certainly in the earlier stages of this recovery, that was really sort of the bastion of strength, right, for the U.S. economy. We had a weaker dollar, we arguably had more competitive goods and services, and we had eager trading partners in Europe, Asia Pacific, and elsewhere. That picture has changed, right, for various reasons, probably most notably the pronounced economic slowdown in many regions, most notably, I would say, Europe. So I would say that's the place where we really felt it. In terms of what our view is on how that could impact us as investors, so we're not expecting a euro breakup. We think that Germany, which obviously is sort of the glue that's holding basically the union together in any practical sense, we think they have a vested interest in keeping it intact. And though they saber rattle about their unwillingness, right, to bail out what they feel like are profligate borrowers or irresponsible spenders. You know, I think that we've seen that they've given the ECB some rope. Mario Draghi, right, the famous Draghi put, and you wouldn't go out and espouse what he espoused, would do whatever it takes if he didn't have the implicit backing of the Germans. And so that's something that gives me some tacit confidence that Germany, or I should say the euro, will not break up. We think the real story there, though, is growth, or lack thereof. You know, we've seen, and it sounds like you have some firsthand experience with the number that the sovereign debt crisis has done on growth, and the austerity measures that have been enacted in various places have done on growth. We got some UK numbers today. There were fears that the UK was about to triple dip. It just missed that. So, you know, hooray for UK, right? They didn't triple dip, but, you know, one could argue that one of the reasons why the recession has been as weak as it's been there is that they've enacted austerity, in my view, a bit too aggressively. They've not been as accommodative with monetary policy as they ought to have been. And so until they're more accommodative, until they do things at a fiscal, at a local level to stimulate growth, I think that it's going to be very, very slow growth, if not recession. So that's our concern. Having said all that, this is the reason why I paused a bit and hemmed and hawed at the beginning. The silver lining is you can actually find some pretty cheap stocks over there right about now. You know, just think back to, let's call it January or February of '09, right? I mean, we look like a basket case, right? Maybe we were Europe at that time. It looked like the economy would never grow again, and it would be very difficult to stimulate growth anew. And yet, as we found, you know, a slow growth recovery has ensued, and a very resounding market rally has ensued. And the reason for that is a lot of stuff got pretty cheap, unusually cheap, and that's translated to good returns in the market. And so that's why we get interested in a careful way in some of these European equities that have sold off, especially European large caps that sell in a number of markets in various currencies. So how's that for a succinct answer?
Good.
Maybe
Just to expand on that, just one point. The United States, with our deficit spending at record levels, you know, basically Europe looks like, because of Germany, looks like they want to take some of their medicine now. The United States still isn't starting to take its own medicine. How do you see that happening? What's going to happen there in the long term?
So believe it or not, the deficit, and I realize this isn't going to be very satisfying to you given that we continue to run gaping deficits, but the deficit as a percentage of GDP is actually shrinking. And it shrinks pretty markedly even in the last 12 months, and projections are that in a couple years' time, the deficit as a percent of GDP could shrink as low as 3%, right? Which, you know, nobody's going to turn cartwheels over, but there is actually deficit reduction that's being achieved, and it's the good old-fashioned way, right? It's some reduction of spending, and it's also, it's just recovery in the income base, right? We've seen incomes improve to a certain degree, you know, and that helps, right? That helps us in the revenue side of the ledger. I guess, like, if I had my druthers, right, and I could go and sort of draw up fiscal policy, I guess what I would advocate is a gradual enactment of fiscal balance, right? So reduce spending. I would probably hike revenue in various places, though controversial though that might sound. I wouldn't do it all at once, and I think that's the key difference between what we've seen here in the U.S. and Europe. I think that Europe was a bit too aggressive and a bit too unaccommodative when it came to realizing that they're in the midst of a liquidity crisis, right? They're in a deleveraging crisis, and so you've got the private sector reducing debt, and so one could argue that in that environment, the public sector needs to be increasing debt, taking up some of the slack as we've seen them do here in the U.S. They haven't done that, and I think that's actually aggravated the situation because growth has been very, very slow if there's been any growth at all. And in some locales, that's made the deficit situation even worse. You know, because it's not just sort of spending that counts and the deficit that counts. It's also GDP that counts, right? That denominator, you got to make sure it continues to grow. So I would say I'm a gradualist. Enact it, but phase it in gradually so that the economy, which is fragile, can basically gather strength, and then at the appropriate time, you can enact some of this.
Then Japan basically is following the European market of taking medicine now. You're saying that you think they are probably also being too conservative?
Actually, Japan is probably, one could argue, the most fascinating experiment in economics in the last 30 or 40 years because they're doing QE, great guns. Abe and the fellow that he appointed to head up their central bank, So they're going to buy very, very aggressively. And so I would say that the deficit and running deficits and fiscal balance there is not top of mind for them. I think what they're most interested in is reflating that economy. And so they're buying Japanese government bonds, JGBs, very, very aggressively in the name of trying to raise inflation up to 2%. So I would say that probably Japan at this point is Europe's opposite number in terms of fiscal approach.
I have a question for you. How do you think Germany can prop up Europe when half of Europe doesn't work or want to pay taxes?
I don't think they can. I don't think they can. And I think it's one of the reasons why a solution, sort of a comprehensive long-term solution, which we've all been craving, has been so elusive, right? Because, you know, like we've talked about, imagine TARP, right? Our beloved TARP back in 2008, 2009. So imagine we didn't have to just get that through Congress. We had to get it through 17 different legislatures of various kinds, right? And you know, I think it speaks to your point, which is that there's a certain level of social and political dysfunction that continues to plague the region. And so, you know, if they're looking for a long-term fix, that's it. I mean, they could go, I think they've gone and they bought themselves some time, Draghi has, by saying that they're going to go out and basically do whatever it takes. Those were his words. And that helped to re-liquefy markets there, which had grown highly illiquid and was getting dangerous for a time. But they still need to address the key issue, which is growth. And until they address the sorts of issues you mentioned, you know, we think that they'll grow very slowly, if at all. So that's why we're not big bulls on European economic growth. It's among them. Yes.
Have you seen any signs that manufacturing is coming back to the U.S.?
Yeah, that's a good question. We have seen some signs, but we haven't seen emphatic signs of it where it counts, which is in the jobs, basically. And also wages have been fairly anemic. In the manufacturing and service sector, generally speaking, wages have been anemic. So yes, I mean, there's been some signs that manufacturing is onshoring here, right? But not in the way that really matters, which is that there's a big manufacturing footprint of the sort that we maybe had 30, 40, 50 years ago. So, you know, I am actually optimistic about manufacturing and our ability to innovate in that space and compete effectively. You know, I think that it's easy to get pretty down about the U.S. economy, given its frazzled state, but I don't have any mention of it in my presentation today, but we'd be remiss if we didn't talk about the energy renaissance that we're experiencing here in the States. I don't know, I mentioned this to another group, that the region that's responsible for 1% of the world's oil output is, believe it or not, North Dakota, which is probably something that would have been unimaginable to us as recently as 5 years ago. And I think it to me, the glass half full part of me says that it really illustrates the regenerative juices of capitalism here in the States. I think that we have a system that really does promote innovation, and sort of creative destruction, which is sort of the hallmarks of capitalism. And we've seen that in the energy sector. You know, horizontal drilling, fracking, I know is very controversial, but we can't really dispute the fact that it's unlocked an energy source that we didn't even imagine being available to us, 3, 5, certainly 10 years ago. Good questions. Okay, so I'm going to move. This is actually consider an act of mercy. I'm not going to show you all the slides that I prepared. So we'll go through some of them, but not all of them. I'll stick to what are sort of the money slides. And this is one of those money slides where, we started out in sort of journalistic pyramid fashion, start out with the conclusions, and then we'll telescope down to some of those details. And then I promise I'm going to leave you with a few thoughts of like, I've got a portfolio, 60-40 portfolio. How might I lean in one direction or another? We'll close on that note before we do Q&A. So some of these things won't come as a particular surprise to you. We are not expecting the U.S. economy to grow at a particularly emphatic rate. We're not expecting recession this year. By the same token, we think that the economy is going to have to continue to grind higher. And so there's some win some, lose some to this, right? So we talked about one of the things, manufacturing. So manufacturing and trade, which had been bastions of strength for the U.S. economy for our recovery in the early stages, isn't what it used to be. Manufacturing and trade have slowed down because many of our trading partners themselves have slowed down and kind of hunkered down a bit. That's one of those lose sums. We also are dealing with the after effects of fiscal tightening of various kinds, whether we're talking about the resolution of the fiscal cliff, whether we're talking about our beloved sequestration, right? These are all forms of fiscal tightening, and short-term they're likely to be counter-stimulative. They don't help us to growth. One could argue they actually are a force that contracts short-term. Long-term they may well be laudable in achieving greater fiscal balance. When we're focusing on the short-term, they put some pressure on the economy. It's another lose sum. What about the win sums? So one is a more resilient consumer, and we'll talk about some of those measures in a minute here, but we're seeing some signs that the consumer, after being dogged by debt issues, by joblessness and other factors for quite some time, they're a bit more resilient lot now than they were before. We'll talk about that. We also should talk about residential investment. That's not something that we've talked much about in recent years because it's been conspicuous by its absence. So I think we all know how bombed out the housing market was post-2007, really. It's taken a while to work off those excesses, and by many measures we have. The market appears to be in a state of greater equilibrium. Inventory, as we'll talk about, has come way, way in. And that's a good fact for the housing market, and more pointedly, it's a good fact for residential investment. Residential investment, as you can imagine, is very closely tied to the housing market and its strength. And as the housing market strengthens, so too should residential investment. And that's another piston that can fire for the economy. I want to also talk very briefly about the markets, and I've got some slides, so we won't go into them in glorious detail. The markets look fully valued, and that's not a pejorative, right? When I say the markets look fully valued, if we were to go and sort of look at what we think fair value is for the market seems to be flirting with that. By some measures a little bit above, by others a little bit below. We'll talk about that. We still prefer stocks to bonds for the long haul. We'll talk about why that's so, but the main issue in the fixed income market, as you know, is very, very paltry yields, and that's something that certainly informs our thinking there. Our other bit of counsel, if you learn nothing else from today's talk, it's this: diversify. That's certainly what we do in our portfolios. We've tried to think very expansively about portfolio construction, making sure that we're using all the different asset classes at our disposal. In an environment like this one, where assets look a bit more fully valued, we think it really behooves us to spread out and make use of all those different asset classes. In certain cases, we've got to hold our nose when we're doing it, as when we're investing in cash, right? Where we're earning a negative real interest rate, basically. One other thing that I would offer, and you can take this for what it's worth, we've come through a season where there was a great deal of rhetoric and debate about the right fiscal approach for our country, and there was a lot of sort of armchair kind of quarterbacking, backseat driving. We would tune out that noise. We think it's very hazardous to your wealth. It's very, very difficult to predict political outcomes, especially given some of the characters that sit on the Hill at the opposite end of Pennsylvania Avenue in Washington, D.C. It's even more difficult to figure out what the investing implications of that are going to be. So our counsel to you is don't do it. We don't do it in our shop. We don't figure out, okay, fiscal cliff means this, therefore we should do this in our portfolios. We would strongly discourage you from doing that. You can really do a number on your portfolio because the market has a way of wrong-footing us in situations like those. Okay, this is where you're going to see me jump ahead a few slides, but I do want to cover this one. You're probably skeptical I'm going to skip any slide here, but I promise I will. So sometimes there's a question like deleveraging. What does that mean? So deleveraging, simply put, for those of you maybe haven't heard the term, right? It's selling off an asset to pay down debt, or it's foregoing something in order to right-size your balance sheet. Okay, and so this is a chart. It comes to us from the Federal Reserve Bank of New York, and don't focus on the colors, right? Focus on the trajectory. And so what we have seen is that households have shaved nearly $1.5 trillion from their balance sheets. That's deleveraging. So this is them going and correcting what needed correcting on the balance sheets. And most notably, that was mortgage debt, right? We went through this foreclosure and short sale phase. Others went and downsized to try and cleanse their balance sheets. And so this is what it looks like. This is deleveraging writ large. And what's the problem with deleveraging? Well, when you're deleveraging, you're not extending, right? You're not spending, you're not splurging, right? You're not buying that plasma TV, you're not going out for a nice dinner because you got to save, right? You know, if you are a lender, you're not using your balance sheet the way we would want you to, you're holding back. That's really sort of the residue of deleveraging. And that's one of the things that's plagued us to this point in the recovery. One of the reasons why this recovery is felt and looked a little bit crummy, right? Certainly by historical standards, is that we've had to overcome this deleveraging wave, which tamps down spending. We'll give you one example here. This is a survey that an outfit called the National Federation of Independent Businesses conducts each month. And they poll small business owners and they ask them, what's the biggest problem facing you? And so the two top problems are listed here. One is taxes and government regulations, right? So nettlesome sort of government issues, right, that are getting them down. And so that's the top issue. But the other thing that you can see that had plagued small businesses was poor sales. The demand just wasn't there. Again, this is one sign, one emblem of deleveraging. It's one of the reasons why the economy hasn't grown as robustly as we might hope. I'm going to skip this in the interest of time. I wanted to talk a bit about some of the good things that are going on. And that's the consumer. And again, this comes to us from our friends at JP Morgan who prepared this chart. So this is an index. It just tracks consumer sentiment. Are you brimming with optimism? You know, are you down in the dumps? And so the higher the line is, the better consumers are feeling. They were a pretty gone lot not too long ago. We can actually see that picture is changing a bit. I've encircled it here. And you can see that consumer sentiment's below the historical norm, but it's improving. And I think this points to the resiliency of consumers who have done that tough sort of shovel work of fixing their balance sheets, and they're now ready to extend, to a greater extent certainly than they were before. Again, that's part of the good news. What's another part of the good news? Housing. So I mentioned earlier that one of the biggest stories we feel in housing, don't worry about all this noise up on the screen here, I'll try and explain it to you. One of the biggest stories in housing, it's not demand, it's supply. Supply of housing has come way, way in. And focus on this lower right-hand chart, right, for you wonks out there. This is home inventories. And so home inventories have come in tremendously, as you can see that correction. And so when we look at measures like inventory to sales, they're very, very low, very reasonable. And so with constrained supply and even a steady level of demand, we know what economics tells us, that home prices gradually get off the map, as they have. This is a very good fact, not only for the housing market, but also related industries like construction. And so this is where my most hopelessly wonky here. This is a really busy slide, but this shows changes in residential investment. Focus on the part that I've encircled. Residential investment, you remember me saying, is closely tied to the strength or fragility of the housing market. Residential investment has been MIA to this point. Usually residential investment, it leads you into recovery and it also leads you into recession. It was different this time because the housing market was so tremendously overbuilt. That principle didn't hold this time around. But lo and behold, what's happening right now? Residential investment is starting to perk up. And actually, if you look at jobs reports, which we get the first Friday of every month, what you find is that construction labor is actually improving. We're seeing jobs added to the ranks there. That's a very different story than even 12 months ago. We think this is an important part of that win some story. We talked about some of the negatives. We think this is a decided positive. One other thing, there's that central bank, the Fed, and their counterparts abroad, right? They're doing certainly their level best, pulling out all the stops, right, to stimulate economies, to create a wealth effect. And again, these are busy little charts, again, from JP Morgan. Very good charts, but busy. Focus on the expanding central bank balance sheets. So this is them printing money in sort of layman's terms. And you can see the way those lines have bucked up towards the top right corner of that chart. It's one signal of the lengths to which central banks are going to induce us to take risks, to create that wealth effect, to get us to extend. This is a pretty big factor in the markets right now. And you can see it here. This is a chart that shows the S&P's rally through the various phases of quantitative easing. They're color-coded here, QE1, QE2, QE3, Operation Twist, what some are calling QE4 or Infinity. These are all things that have created an indelible impact on the market. I'm going to skip this again in the interest of time. I'm going to spend a few minutes on stock market valuation because that's the other thing that's very near and dear to us, right, as stock investors. So do stocks look cheap, dear, reasonably priced, how might we characterize them? And so we put together a few slides. I'll run through them quickly and try and give you a fast bottom line here. What I would tell you is the picture is mixed. By some measures, U.S. stocks look cheap. By others, they look fairly valued, if slightly rich. We'll show you that in a minute. The wild cards are earnings growth, profit margins, and then dividends and stock buybacks. So here it is. This is probably one of my more accessible slides. Don't all share at once, but green light, yellow light, red light, right? So we're looking at various measures of stock valuation. Forward PE, trailing PE, what's called the Shiller PE. Don't worry, don't sweat those details. These are just various ways of measuring the valuation of the market. Some of them similar, some of them dissimilar. And you can see the signals are mixed. If we look at a forward PE, the market looks pretty reasonably valued, 13.8 times versus 16.2 times as the historical norm. If we look at trailing earnings, it's slightly rich, right? And then if we look at a Shiller PE, it looks richer yet. Mixed signals in terms of whether stocks are overvalued, undervalued, or about right. Morningstar, for its part, also tracks the value of the typical stock. Is it cheap, dear, reasonably priced? And so again, don't sweat the chart. Suffice it to say that when we look at the typical stock that our analysts cover, call it the 1,000 first stock, the median stock in our coverage universe, stock looks about fairly valued, right? Another of those signals that we consider, another of those things in our mosaic that suggests that stocks look about fairly valued. So a couple things to keep in mind, and then we'll close this out.
Wait, Jeff?
Yeah, please.
Can you just go back to this slide? Because
Yes.
I think it's an important point where you're saying that stocks look reasonably valued, which is what we're saying as well. But within the stock sector, within stocks, the defensive sectors look like they have reached full value or might be excessively valued. And yet some of the cyclicals and industrials look attractively priced.
Exactly right.
Well, I think that's an important distinction for people because I don't want them to run from the stock market as a whole. There's still value there, pockets of opportunity.
For sure, which is a good segue to a point I was about to make, which is that one must be selective when it comes to choosing equities right now. So the market is not a monolith, right? There are some stocks and some sectors that are cheap. There are others that are less so and some that are rich. And so this chart that you can see in the lower right-hand corner, which basically focus on where it's pointing and its color. The greener it is, the cheaper it looks. The higher it points and the redder it is, the more expensive it looks to us. And you can see that there's quite a spectrum there. There are some sort of heavy industry basic materials that look quite inexpensive, right? And then there are some other names in more what are traditionally defensive sectors. Many of them, sectors that pay fat dividends that look a little bit extended to us, right? They look a little bit more overvalued. So the bottom line is one must be discerning. It's not to run away from, the stock market like it's a burning building, right? It's that you have to go and pick and choose and be selective.
So what's the sector on the left?
Sector on the left is basic materials. To its right is energy, communication, financials, and then you're at technology. In the rightmost portion, real estate, consumer defensive, and utilities, which are traditional sort of dividend bastions. Yes?
What industry are we seeing as the biggest growth industry now?
Yeah, sure. So, people would still focus on areas like tech and healthcare. I think that health and biotech in particular, right, are pretty dependable, sturdy growth industries. I mean, if we just focus on things like demographics, right, it's a pretty good fact, right, for the healthcare industry, and especially biotech when we think of things like genomics, right, and, our ability to go and, attack various disorders, diseases, right?
What are they saying about solar?
About solar, it'll grow, but whether it'll be profitable to shareholders is another matter, as I think many have found, right? Owning solar stocks has not been the most profitable endeavor in the last few years here, and so again, you want to make sure that it grows, but you're paying a reasonable price for that growth.
What did they do about wind? Did they ever do anything about the wind stocks too? That was supposed to be another area.
Yeah, they've all suffered. Yeah. Any other questions before? So I've given you sort of the green light, yellow light, red light on valuation. Two other things that I'll just quickly mention, then we'll move to sort of our takeaways, and then we'll leave time for Q&A, what's left for it. So a couple other things to keep in mind. One is earnings growth and sustainability. And the key point here is margins. Profit margins have been pretty wide, and they're likely to narrow. and that's something that could pressure earnings growth, which is generally not a good thing for stocks, and we have to make distinctions between them. But one thing I did want to point out is that firms are awash in cash, right? They have a lot of cash sitting on the balance sheet, a historically large mountain of cash sitting on their balance sheets. And what can they do with that? They can use it to pay dividends. They can use it to fund buybacks. And these are all things, as equity investors, that can be very, very friendly indeed to us. And so that's something that could be more than an offset to the slowdown in earnings growth that we're seeing. So again, a mixed picture for stocks. There are bargains to be had, but one has to look carefully. There are encouraging signs, such as the rate of dividend payments and buybacks, and yet we have to keep an eye on earnings growth, a mixed picture. One area, and this is real quick, we are focused on Europe because we're seeing cheaper valuations there, which is something that's illustrated here. But I don't want to belabor it so that we can get to the end. One last point on bonds. Focus on the right chart here. This is the percentage gain or loss for a 1% change in interest rates in various types of bonds. And so I'll focus on one of these, the 30-year U.S. Treasury. So if we have a 1 year, or I should say a 1% increase in interest rates, you're looking at a 20% paper loss in that Treasury bond. Not the sort of number you would normally associate with a fixed income security, and that's why we implore you here to be careful out there, right? Bonds help to stabilize a portfolio, but obviously you want to pay attention to things like the amount of interest rate risk that you're courting. Okay, so without further ado, some questions and some attempted answers, and then we'll conclude. Did you have a question first?
Yeah, what's the best sector to be investing in right now?
In the equity market or in fixed income? So on a valuation basis, there's probably two places we would look. One is healthcare still looks reasonably priced to us, considering the growth prospects and the quality of the firm's concerned. We actually also, if you're more daring, we also like the stocks of natural gas producers and explorers. Those also look very inexpensively priced to us. The energy sector as a whole doesn't look terribly expensive. So, you know, if you're less daring, that might be another way to approach it. Those are probably the areas I would focus on. Sure. Okay, so questions and answers, and then we'll wrap it up. So economic growth, I covered this. A continuing sluggish, tepid recovery. Why sluggish and tepid? It's due to ongoing deleveraging, right, and fiscal pressures that we're experiencing as the federal government, states and municipalities belt tighten. What about the jobs picture? We haven't talked about that. It stands to reason that if the economy is lumbering higher, you know, companies aren't going to go out there and expand their jobs ranks very aggressively. And so, you know, we think that the jobs market will also have to grind higher with the economy. Real estate, I know that we have some various investors and followers of the real estate market here, and you're probably better authorities on this than I am. When we look at publicly traded REITs right now, we don't see values aplenty. We think the real estate market is healing. By the same token, you have to be attentive to valuations and what it is you buy. And so that's our focus there in real estate. With respect to Europe, we talked about that earlier, and I'll dispense with that. I think growth is the issue there, that there are some bargains to be had. Then emerging markets and commodities, the key issue for emerging markets is, do they slow down in an orderly way or a disorderly way? Our bet is on orderly, and we're actually attentive, looking for opportunities to buy emerging markets stocks on the cheap should the market present us that opportunity. And then I'll conclude on one last note, since we were talking about commodities a moment ago. Commodities actually are one of the few, I wouldn't say one of the few interesting parts of the market, but they're one of the parts of the market that have been left behind in recent months, or really over the last year. And so that's another area that we've been focused on. If we were thinking about tilting a portfolio, probably towards stocks for the long haul, focusing on high quality, probably looking at things like commodities. And so with that, I'll go ahead and wrap things up here, but if there are any questions I can try to address, I'm happy to do that. Yes?
Apple. They did announce a major buyback, $50 billion,
Yep.
and the stock went down after that. Today it's about to stabilize a little bit. Could you explain that?
Why it went down?
Yeah, such a large, you know, about a third of their cash positions have been returned to the, or will be returned to the shareholders.
Yeah, so the question for those of you over there, Apple, right, and they announced a very large buyback authorization, and yet the stock went down, which is a very good point. And so why was that? It's hard for me to speculate, but my best guess is that it was the relatively tepid guidance that Tim Cook, the CEO, gave for the balance of this year. I think that the street was hoping that they would bring out a new product in the summer months, and I think what he was saying was basically it's going to be late this year at best, right? And so I think that for certain, especially momentum investors, they're really craving something that'll give earnings a pop, because the comparables are not great, right? For the next few quarters, earnings growth is going to be a challenge for them. And so I think it was really that guidance. But your point is a good one, right? And actually, we think the stock looks pretty reasonably priced, if not downright cheap. And when you consider the buyback as well, it's a lot of firepower that they're marshaling on shareholders' behalf. So yeah, that's something that I would look at for sure. Yes?
Jeff, terrific presentation.
Thank you.
Very relevant, lots to digest. The dividend plays over the past 4 or 5 years has been a great place to be, right? So you not only got a 3-4% dividend, but you got capital appreciation of 15, 20%, stocks like Verizon and others. You think the play is over, or you think there's still more there?
Yeah, it's a real good question. So dividends, and will the rally there continue, which has been very kind, as you observed, to many dividend investors over the past few years. And I don't want to be too categorical about dividend payers, because there's such a wide diversity, and some of them are reasonably priced, while others, right, as we showed in that slide a few moments ago, look a little bit richer. So I think for one that's selective, right, picking and choosing, being very attentive to valuations, I think there's still good money to be made there. But you really have to be discerning. It's not the turkey shoot that it was maybe a couple, 3, 4 years ago. You got to pay attention to what it is that's paying the dividend. Sure. Yes.
Isn't it appear that over the last, I couldn't quantify the years, but the profit margins that companies are making are becoming slimmer? I have a business, so I'm seeing my profit margins pink, and I'm assuming it's because the costs of everything are just going up in such a great capacity that it's just harder to run a business these days.
Exactly right. Yeah, that's a really good point, and it's wonderful because it gives me an excuse to show a slide that I skipped over. Just kidding. So, focus on this is probably you're probably not expecting this. It's like a nightmare that you have to go through another slide. So this is, we've got the pillar here, I'll describe it for you. So on the right, the chart on the right here, we're actually showing adjusted after-tax corporate profits as a percentage of GDP, right? And you can see what the historical average is, about 6.2%. And so what we can see is that profits as a percentage of GDP, they're really out of line. And I think it speaks to your point, which is that profit margins have indeed been very, very high. And so one of the things that's happened, to your point, is that profit margins, which tend to be mean reverting, they've been coming in. And one of the reasons is just we're not able to get the kind of productivity out of our resources and out of our labor in particular that we could before, even in a benign inflation environment.
Also because everything is cost. The costs of running a business today are just going, it's just going up and up. So your margin is going to get small. If you were making 50%, it's just going to get smaller and smaller.
It could indeed.
And I kind of wonder when that's going to, if there's a plateau ever to be had there. But I don't know how things are, I can't figure out yet how things are going to catch up with each other.
Yep. Yeah, so it's a good question. And the short answer is I don't know the answer to that.
If you
to
did.
be totally honest. But, I guess the one thing that we can observe is that inflation, by any reasonable standard has been pretty benign to this point. Though I know that, with regulation and the associated costs, Obamacare, right, these are things that have real economic cost to them. And I think that, your point is a good one, right, that one would hope that there is a stabilization there and that profits could begin expanding anew. But, the one thing that we have to keep in mind from an overall market perspective is that, profit margins still remain quite lofty by historical standards. And so that's likely to bring earnings growth down, which is the second chart that I'm delighted to be able to show you here that I didn't have a chance to show earlier. So this actually shows earnings growth, EPS growth year over year, but it shades it, and it shows the portion that's attributable to expanding profit margins, and then the share that's attributable to unit growth. And so focus on that sort of grayish portion that's shown there. You can see that in the early stages of this rally, that margin expansion played a very pivotal role in the earnings growth that companies enjoyed. And we can see that that story has changed pretty markedly in recent quarters. Doesn't mean that we should all be down in the mouth about companies and their earnings power. The earnings season's going on right now, and it's not a calamity. Companies are doing just fine, but this is one of the headwinds that they'll face as time goes on. Margins come in, they revert to the mean, and that's what we're seeing here. What we hope is that economic growth can help them to counteract that, because they'll have better revenue, that is unit growth, and their earnings will grow as a result. Yes?
What sectors has all the stimulus money really helped, and has it added to the national debt?
Yeah, so the stimulus money has added to the national debt in the sense that it's been deficit widening, and we've had to finance that by floating debt. I wouldn't say that it's been the pivotal factor in explaining the increase in our national debt, but it's been a factor. In terms of beneficiaries of, so is it stimulus you're interested in, or quantitative easing?
It's stimulus.
That's a hard one. You know, I mean, I would say that there's probably some areas in industry and infrastructure, one could argue, that have been beneficiaries of that. I would think that, I would probably focus a bit more on quantitative easing. When you're thinking about sectors that have been maybe the beneficiaries of fiscal or monetary policy, quantitative easing is where I would focus, and the sector that I would focus on is financials. Financials, I think, have been the big beneficiaries of quantitative easing. The Fed's zero interest rate policy, it's kept borrowing rates very, very low. It's given them an opportunity to go and mend their balance sheets. And it's given them some opportunities in other markets to go out and make money just by basically playing the slope of the yield curve. So I think the financials, and also, I mean, just general risk-taking is something that invests in, that helps investment bankers and the like, and that helps financials. So that's probably the sector that I would point to.
In fact, everybody, right? Because all corporations got benefit by lowering the cost of the financing.
You could argue that,
Yeah.
exactly. Yeah, so money is, to your point, as money has gotten cheaper, that's good for all types of enterprises. Now, one would argue that it's friendliest to companies that need the capital, right? And that have financing and refinancing that are out there. It makes it very inexpensive for them.